Hello, hello. How is everybody? Be shy.
No one's talking.
This is an interactive program.
Well,
Hey, Bob.
Gentlemen, you don't
hi,
generally
Bob.
expect me at 12:30 on excuse me, I know it's 11:30 your time.
Yeah.
But needless to say, I want to tell you something, Mark.
Okay.
By the way, I finally found out I have a Fidelity program, but I didn't have the, what do they call that? The
Active trader.
Active Trader Pro. And I
Right.
got that going this week, and I've been using it extensively
Good.
for investments that I'm in, for investments that I'm looking at. I have 4 questions, and I don't know what is the appropriate time to go into these questions. I think they're pretty quick.
Go ahead while we're waiting for people.
Can I go ahead?
Yeah, go ahead.
Can you bring up, I'm going to have you go out to a stock. The stock is ALAR.
Can I share my screen?
If you would, please.
Yeah,
Yeah.
go ahead.
Okay. Yeah. Come on. Here we go. Okay.
All right. I for well, I've right now, here's what I've got. I've got 3 green lines, and I've got 3. You got purple. I guess mine must be purple too. I don't understand why I've got 3 and you've got 1 of each.
What do you mean 3?
I got 3 green lines that
Oh,
are
you probably see this line here. This is the 9. Okay. Right here.
the green is 9. I understand
Yeah.
that.
Yeah. So you can go up here. Here's 9. You can see all these up here on the top.
Yes, I
This
do.
is all-
Yes.
So you can go up and modify. You can make them any color you want.
But
See,
why
I
do
can
I
move.
have 3 green lines?
Well, probably because when you programmed your lines, it just automatically came up with a line color it chose.
Yeah, it did. I didn't choose the color. It just
Yeah.
automatically.
So you can go up like here's the 20. Okay, here's our 20. It's blue. And you can go up, modify it, and you can make it orange if you want. So it comes back orange.
Yes,
So
I understand that.
so that's what you got to probably go do, you know.
But I spin? Those aren't really lines. I mean, there's curvatures in them. But on this green, that is resistance, right?
Up here.
Yes,
Yeah, that's a green line of death.
that's a green line of death, and that's a resistance.
And I always have mine set to intermediate. Okay.
Intermediate. Gotcha.
And all you do is, you just pop on the left click on it and it says modify, and then you can go in and hit intermediate. A lot of times it doesn't make too much of a difference. There's a long term, it really didn't move it. Short term really didn't move it. That's why I just keep it on intermediate.
All right. Now, by the way, since you've got this on here,
Okay.
on the MACD, I take it that blue, it looks like blue charts.
Yeah, this is a histogram.
Oh, is that a histogram?
Yeah.
That's not a signal level.
Now you see there's a 0 line here, and when the histogram is below the 0, that's when the MACD line is below the signal line. And then like right here, it's popping above it. You can see.
Mm-hmm.
And you go over here and you can see that the MACD in mine is red and the signal line is green. And then this is the histogram here. And when it crosses over, the histogram goes above the 0 line. And you can see that In this case, on my chart, the MACD is negative 3.56 and the signal line is negative 3.65. So it just barely crossed. And now today you can see it's even crossing more. And you can see it by the histogram. You can see it by the candlestick. This came right up and it hit where the sell order resistance level is, right here, and got
Yes.
stopped, and it's trading a little below it. Okay.
All right. All right. On the SS, I guess that's slow stochastic.
Slow stochastic, yep, right here.
If the percentage K is greater than the percentage D,
Right,
that's bullish.
correct.
And likewise, if the percentage K is less than the percentage D, that's bearish.
Absolutely, yep.
All right, I understand that. I understand RSI. I got to
Okay.
go back to MACD.
Okay.
Because my understanding was not correct. But when we talk about, I say charts, bars, that's what I should be saying, bars, those blue bars.
Yeah, the histograms.
Those blue bars are histograms.
Yep, and they just represent when the MACD line, which on mine is red, crosses over the signal line, which is green. You'll see those bars go higher. It's just another visual that you can go and look, and basically see. Oops, hold on. Let me make this bigger so we can see it. There. So it's just another visual. As long as this is under here, you're going to see the histogram below that zero line. And once it crosses, it's above the zero line. And you can kind of see if it's going up, kind of going sideways, then all of a sudden it's down. And now we can see, you can look at either line and kind of figure it out, but it went sideways and now it's coming back up, which is a good sign, and then it crossed over. And about that time, it even crossed over the 9, okay, right about where it crossed. The slow stochastic, I use that because I found just that this one gives me kind of an indication that a day or two before that the MACD is probably going to cross over too. You can see this one crossed over a couple days before. And so it just kind of is a double validation for me that we're going to see some positive trending up on price action. Does that make sense?
Yeah, all right. So really that green dotted line is a signal line.
That's a signal line, yep. And this is the MACD line.
All right. So I guess I'll have to go back. I don't understand why I've got going back up to the top there, why I have 3 green resistance lines and you got 1. And I know what you did. You're clicking on the green line.
Did you go here to put it in?
Yeah, I've been in there.
Okay, because you take that off and they go away and then you put it back on and they're there, okay?
Mm-hmm. Oh.
And here's your stops, okay, which is this purple line here on mine. Take that out, put it back in, okay?
All right. I'll play around with that.
Yeah, no problem. Yeah, you can DM me anytime or just go to my office and ask questions too, and I'll get to you when I see it.
No, I appreciate it. And
Yeah.
the other thing, I'm very happy that I have the same system that you have. It just makes it a lot easier to talk with you.
It does, yeah.
And so anyhow, very good. I won't. Oh, by the way, I do have one other question.
Okay.
What is a Bollinger Band?
Bollinger Band is basically a statistical chart that it follows off the 20, and it's either 2 standard deviations above or below the 20, okay? And when Bollinger Bands are widening out, you see movement either up or down, and when they converge together, you'll see that the price action is sideways. So normally, only 5% of the time does a stock trade outside of the Bollinger Band, either up or down. And I found that if you're trading above the Bollinger Band, you hardly ever see it trade above it with the full candle more than 5 times in a row, and it'll pull back in. So just my observations.
All right. All right.
Yeah, it's just another way to see kind of momentum, and those Bollinger Bands, some people trade off of them. If it hits the lower one, they get out. If it hits a high, they get in. If it hits a higher one, they go out. Some people just trade off the MACD. Okay.
All right.
Those are kind of risky to me because it's like flying a plane. I've got all kinds of gauges that tell me how much fuel I have, what my altitude is, what my airspeed is. I could fly with one gauge, but why?
Oh, I understand. No, I
Yeah.
understand. That's great. Thank you, Mark. Thank you.
Yeah,
By the
no
way,
problem.
this was not something I was using for trading. I have a small part of this company, but that was not for trading at all.
Okay. Well, the chart was looking fairly good. It was underneath the 200, but it was still trending in the upside. If you could get past that sell order resistance level, you might have some more room to go.
Well, this stock, let me tell you, I made money in it, and it got up to 44, and then I think in the past month and a half, man, the thing went crashing. And
Yeah.
and it wasn't exactly the numbers that came out with in terms of the quarter revenue and earnings. It came out, I think, with a forecast that was slightly disappointing on the earnings, and man, the market just crunched it.
Yeah.
So anyhow, that was a weird one, and that's what I wanted to bring on.
Okay. Yep. All right. Well, I'm going to get going. I see we have chat talking about Scott's dog. I love German Shepherds. I had one. He was 21 years old when he passed away, and he was an Aleutian, which meant his snout and his ears were darkish, but he looked like a golden retriever. He didn't have any darkness in the rest of his body, which was kind of a cool dog. Yeah. So he was with me for longer than most everybody in my life. So okay, he was a good dog. Anyway, we had a weird market this week. I mean, we had the CPI and PPI came out after the jobs report last Friday, and it's just the market is uncertain, and now the market is focused more on rate cuts. Okay, next week is the FOMC, so that'll be the big thing, and it's not with what if they're going to cut, it's by how much. So the discussion has been 25 basis points, 50 basis points. To me, I don't care because it took 18 months for these rate cuts to come through the system, and finally slow our economy down. And now they've been looking at the jobs, and they're like, oh my gosh, now we've overdone it on the jobs. We need to cut rates. And then on the other side, we're seeing inflation kind of coming back up. So I want to spend a little time on that because it does affect market momentum. And like this week, I know you guys have been pretty active in trading, and which is good. My trading guidelines, I was in 2 on the paper trade portfolio at the beginning of the week, did pretty good on them. The rest of the time, the market, according to my trading guidelines, told me to just stay out and wait, which I did. Okay, I don't want to fight for scraps or anything like that. Plus, it's swing trading, so I'm not going to sit here and watch it, 24/7. But I know you guys have done well, and I've been watching the Discord, and you guys are doing good. I think in metals today, and that's good. But I want to go back a little bit to last Friday. Last Friday we went way down, and the jobs report came out, and then all of a sudden, this week we weren't doing so well. CPI, PPI, and then the CEO of NVIDIA came out and said the demand was great, but customers were frustrated and blah blah blah, and then the stock market went way up. So we kind of got that enthusiasm back into the tech sector, and we'll see, which is good because I know a lot of people are in the tech sector, and it drives a lot of the market. And that's what I think we've seen, in the last couple of days is the tech sector has come back into play a little bit. But last Friday, the non-farm payroll report came out, okay, and it increased by 142,000, and the unemployment rate went down 1/10 to 4.2%, and that's what the Bureau of Labor Statistics told us. And then of course, when you look down at the bottom, we saw the revisions. And if you remember back in July, when the labor report came out, it was 114,000. Okay, and it made the market tank. We had the Japanese yen carry trade come through. Well, the revision for that month, that was 114,000. was revised down 25,000. So now it's actually 89,000. So think at the time back then, if it would have been 89,000 instead of 114,000, what that would have done to the market. So we are making decisions based on incorrect data by the Bureau of Labor Statistics, who constantly mark these job numbers down. Okay, so when you look at June, they marked it down 61,000 from 179,000 jobs to 118,000 jobs. So with these revisions, the employment in June and July combined is 86,000 jobs lower than previously reported. And it also means that 4 consecutive job prints have been revised lower, and 6 out of the past 7 are revised lower. So again, these revisions are not telling a true story, and then the markets are reacting positively on the headline number, and then the revisions come out. So look a little deeper into what's happening into the economy. The BLS has now admitted with its downward payroll revisions 2 weeks ago that monthly increases in jobs in the past year was not 230,000 per month, as has indicated previously, but 150,000 per month when you remove the 818,000 jobs that were never there in the past year to begin with, which is down 31.2% off the headline numbers. So that's a lot, okay? And when you consider 150,000 jobs created a month is not really growth in the job market, but we're getting reported, that it's 230,000. So just keep that in mind, because that's one of the things that the Fed sees, but they're not really talking about, that they don't want that. They don't want unemployment to get away from it. So looking at the non-farm payroll report a little deeper, the number of long-term unemployed people, and those are jobless people for 27 weeks or more, so over half a year, was virtually unchanged at 1.5 million in August. The long-term unemployed accounted for 21.3% of all the unemployed people. So the number of people not in the labor force who currently want a job at 5.6 million changed a little in August. These people are not counted as unemployed. Okay, 5.6 million people not in the labor force because they were not actively looking for work during the 4 weeks preceding the survey, or were unable to take a job. So there's 5.6 million more people that aren't counted as unemployed. Then among those in the labor force who want a job, the number of people marginally attached to the labor force at 1.4 million was little changed in August. These individuals wanted and were available for work and had looked for a job sometimes in the past 12 months, but had not looked for work in the 4 weeks preceding the survey. The number of discouraged workers, a subset of marginally attached, who believed that no jobs were available for them, changed little at 367,000 in August. So that adds another 1.4 plus 5.6, so about 7 million people who are unemployed that are not on the unemployed list. Okay, so when you look a little deeper, you're seeing that our employment situation in the country is not looking as good as what the headline numbers have been telling us. So when we look at the actual jobs, the BLS reported the employment growth in August was in line with average job growth in recent months, but was below the average monthly gain of 202,000 over the past 12 months. Well, we just saw that if you take out the 818,000, that were really around 150, not 202. So they're still reporting, a higher level month over month. When we get into it a little deeper, we look at part-time versus full-time. And according to the BLS, while the number of employed workers did rise by 168,000, looking closer at the composition of this increase is bad, because it consisted of an increase of 527,000 part-time jobs, offset by 438,000 fall in full-time jobs. Then this means that since last June, the U.S. has added just over 2 million part-time jobs and lost over 1.5 million full-time jobs. So we're not seeing full-time jobs, we're seeing part-time jobs. So if I go out and I lose my job and I have a part-time job, but it doesn't make the money that my full-time job is, and I have to take on 2 more part-time jobs, the Department of Labor Statistics counts me as 3 jobs. Okay. And everyone is doing it. If Trent did it and Trent had 4, he'd be 4. So between the 2 of us, we would have 7 jobs created. And that's how they're manipulating the data on jobs. So we all know part-time jobs pay less. They don't offer benefits. They lead to suboptimal outcomes for the labor market, one of which is the need to get more than one job. Okay. So people who have more than one job jumped above 8.5 million, back to all-time highs. So over 8.5 million people have more than one job. And then when you look at deeper into foreign-born versus native-born workers, since October 2019, native-born U.S. workers have lost 1.4 million jobs over the same period. Foreign-born workers have gained 3 million jobs. In the past month, the U.S. added 635,000 foreign-born workers while losing 1.325 million native-born workers. This was tied for the biggest one-month drop in native-born workers since the COVID crash. So when you look under the hood of the non-farm payroll report, we find that the job market is at best very weak when considering the real numbers regarding part-time versus full-time, number of people with multiple jobs, the number of foreign-born workers injected into our economy, and yet the unemployment rate ticks down at 0.1% to 4.2%. Figure that out. Okay, and then the reason I bring this up is because over the weekend, we're getting confusing headlines, and Janet Yellen. It always seems when things get bad, Janet Yellen comes out and gives a rah-rah speech. So Janet Yellen to the rescue. She assured the public that the U.S. economy's strength, despite recent weak job reports, was resilient. Speaking at the Texas Tribune Festival in Austin last weekend, Yellen said, "We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs." Yellen acknowledged that job growth has decelerated compared to the post-pandemic hiring frenzy, but emphasized that the economy is deep into recovery and basically operating at full-time employment, at full employment. Again, we just looked at it. Okay, full-time jobs are down, part-time jobs are up. Okay, their definition is different than mine. The comments came a day after the Bureau of Labor Statistics released another month of underwhelming job data. So she attempted to alleviate concerns about the economy, stating, "I don't see red lights flashing. The recent jobs data has sparked worries about whether the Federal Reserve can achieve a soft landing by raising interest rates to control inflation and then cutting them before a recession hits." Yellen expressed confidence in this path, noting that there was a significant reduction in inflation. Well, this was before the CPI and the PPI came out. Okay, so she's out there saying everything's rosy. And Trent and I talked about it, on the 2Regular Guys show that we do every week. And she lives in a different world than we live in. She probably, has a government car, drive around. She doesn't have to worry about gas. She probably lives in government housing, doesn't have to worry about rent, or insurance on your house or on your car. She probably doesn't. She probably eats government meals and flies on government planes. So her expenses are low, so she doesn't see the same thing that we do. She lives in a different world. Right under this article about Yellen, and she just talked about she doesn't see any significant layoffs. There was an article about Midwest Transport, that's an Illinois-based trucking and logistics company, which is contracted with the U.S. Post Office to haul mail, notified over 600 employees, including more than 480 drivers, that the carrier is ceasing operations, according to a source familiar with the closure. Right under that article, Macy's has announced it's closing a total of 55 stores by the end of this year in the faltering brand's ongoing effort to revamp its business. So I assume that 55 stores has a lot of employees. I assume there's a lot of truck drivers who deliver products to those stores. I assume there's a lot of warehouses that store that. I assume there's a lot of producers of the stuff that Macy's buys to sell to us. That is not going to happen. So that's going to be a chain reaction down for layoffs all the way down. Okay. Again, she doesn't see any significant layoffs. Big Lots said money filed for Chapter 11 bankruptcy protection of its debtors, with the discount retailer citing inflation and high interest rates for hurting its business. The chain also received a delisting notice from the New York Stock Exchange because the average closing price of its shares was below $1 over a consecutive 30-day trading period. ChargePoint Holdings, the battery charger, company, operated the largest electric vehicle charging network in the U.S. plans to cut 15% of its workforce after missing revenue forecast. Samsung is starting to lay off staff globally, impacting up to 30% of employees in some divisions by the end of this year, according to 3 sources familiar with the scope of the layoffs. Reuters reports Wednesday sales and marketing departments are reportedly be reduced by 15%, while up to 30% of the administrative staff are expected to be laid off. Samsung has about 25,000 sales and marketing staff, according to the report, meaning over 3,700 employees may be included in the layoff. Again, not substantial layoffs. Honda Motor announced job cuts and temporarily suspended operations at 3 plants in Wuhan, operated in joint venture with state-run Dongfeng Motor Corporation in China. Car maker seeks to trim inventories and work on a broader shift strategy towards electrification. The production of these plants has been suspended for 2 weeks from August 26 to reduce inventory. So there's a lot of inventory of cars out there. You go to a car lot, I was talking to Trent this week, and I think he was talking to a Toyota dealer, and they got more inventory than they know what to do with. So they are cutting production in Honda worldwide because there's too much inventory out there. They want to keep making cars because when you have too many cars and too less demand, the price of your cars are going to come down. Okay. So Honda intends to cut about 3,000 jobs from its Chinese business operations by the end of the current fiscal year. Again, this is a worldwide event. It's not just in the United States. And then Seattle upstart Amperity is laying off 13% of its workforce. The company confirmed Thursday that these challenges are not unique to Amperity, he said. The current economic climate is affecting the entire enterprise software industry. Both software vendors and their customers are facing similar economic pressures and having to make the necessary adjustments to navigate these market conditions. That's a lot of words to say that the economy is not doing very well for software industry. And I thought one of the most interesting things was a former Sony Computer Entertainment Europe president, Chris Deering, had a blunt message for recently laid off game developers from Sony. They should go to the beach for a year or drive an Uber until the job market improves. The company said in February to lay off about 900 people globally and close PlayStation studios in London amid a slowing gaming market. Deering dismissed the notion that the layoffs were purely driven by corporate motives. So again, it's almost, if it wasn't so sad, it would be comical. But to have your Treasury Department secretary say that jobs are fine, and you can see this day after day after day. Look at the reports, dig into the reports, and show that our job situation, the employment situation, is not going in the right direction, even when you dig into the government reports. This week, U.S. employers announced 75,891 job cuts in August, the most in 5 months, and the most for the month in August since 2009. Okay, what happened in 2009? When excluding the pandemic-induced crash of 2020. Again, initial jobless claims came out. The number of people claiming unemployment benefits rose by 2,000 from the previous week to 230,000. Okay, this figure remained well above the average seen earlier this year, reflecting the continued trend of softening labor market, further emphasizing a weak August payrolls data. So I have to ask Janet Yellen, what world does she live in? Because she's not living in the world that I see personally. I'm looking at a totally different world. So again, jobs, unemployment. I said that this is the third leg of the stool that's going to fall off the edge. And then once it does, when people lose their jobs, they stop spending. When people lose their jobs, they go on to credit cards and they overindulge on their credit cards. When people lose their jobs, they reduce their savings. When people lose their jobs, they start giving up their cars. You start seeing delinquencies in repos and car market. When people lose their jobs, they lose their houses, and that's just a series of things that happen. So if we keep going in this direction, this is where we're going to end up, in my opinion. So the other thing that the Fed looks at is inflation. And this week, the CPI came out, Consumer Price Index. It was released on Wednesday. And the headline number, which is what they always focus on, and Steve Leisman is gleeful. And and Giddy. We were talking about Giddy yesterday, Paul. The annual inflation rate in the U.S. showed for a fifth consecutive month, slowed for a fifth consecutive month, 2.5% in August, the lowest since February 2021, from 2.9% in July, and below the forecast of 2.6%. This was mostly because energy declined, mainly gasoline, fuel oil, and natural gas. Okay. Inflation for food went down 0.1%, and transportation went down about a point also. Okay. On the other hand, inflation edged higher for shelter, apparel. And compared to the previous month, the CPI rose 0.2%, the same as in July, and matching expectations. But when you look at the core, and this is what the Fed looks at, and the core strips out food and energy, because none of us use food and none of us use energy. It actually advanced by 0.3% on a monthly basis, month over month. 0.2% was predicted. So year over year, the core CPI remains elevated at 3.2%, well above the Fed's 2% target. The shelter index, as a part of the core, rose by 5.2%, housing, accounting for more than 70% of the total 12-month increase in all items less food and energy, up from 5.1% in July. The other index with notable increase over the last year include motor vehicle insurance, which went up 16.5%, medical care went up 3%, recreation went up 1.6%, and education 3.1%. So the stickiness of this core inflation has decisively cooled any residual hopes of more than, of a more aggressive 50 basis point rate cut. Now that's changed a little bit. Now they're thinking maybe 50 basis point. I'll look at a chart here. I just want to show you. Right here, let me pull that down and share my chart. So this is CPI chart, month over month, CPI year over year. And you can see since we've hit, the 9%, and we've come steadily down until, mid part of this year. And now we're starting to see it slow, and we're starting to see a tick up, in the core year over year. And we're definitely saw it, a tick up month over month. So we saw this back in earlier times when we were fighting with Volcker, that they started cutting rates too soon. Inflation came back, unemployment got out. Oh, Trent's back.
Do you think that might explain all-time highs on Visa and MasterCard?
It could be, yeah.
Right.
Until people start not paying their credit cards. Let me show you. Let me see if I can find this. This other one is interest rates. Okay, here we go. That was perfect timing there, Paul. So I appreciate you chiming in. So the Discover and Capital One, okay, these are charge-offs. This is credit cards that they're having to charge off. Okay, you can see back in 2021 and 2022, this was during the pandemic, 1 to 2% of them were charged off. And as of January, this is just January, they were up to 5 or 6%. And it's even higher now. You look at the banks, and I'm going to look at Ally here in a minute. They're starting to see defaults in their credit. Okay. And to the point that it's you saw what happened to their stock prices. They went down. So let's just talk about Ally a little bit. So Ally Financial this week plunged as much as 18% of their stock price, their biggest one-day drop since March 2020, after the auto lenders management presented at the Barclays 22nd Annual Global Financial Services Conference. What sent the stock crashing is CFO Rush Hutchinson warning about weaker credit and net interest income trends quarter to date relative to expectations. Specifically, Hutchinson said that in July and August, they saw auto delinquencies soar a whopping 20 basis points compared to their expectation, while net charge-offs, which is what we just looked at for Discover, were up 10 basis points compared to their expectations. Over the course of the quarter, our credit challenges have intensified, Hutchinson said on Tuesday. Our borrower is struggling with high inflation and cost of living, and now more recently, a weakening employment picture. He also said that the firm may have experienced some underperformance, he said, adding that Ally will evaluate reserves to cover bad loans and increase them if needed. And then you look at inflation. Again, we saw the credit cards, we're seeing what's happening in job reports, and we look at inflation, okay, and everyone says inflation is coming down when only the rate of inflation is coming down. A recent study by savings.com showed that nearly 80% of U.S. adults have cut back on groceries due to rising prices, with 37% reporting they're extremely or very concerned about their ability to afford enough food, and even more people are worried about affordability of healthy foods. Retirees are no exception. As an estate planning attorney, my clients are often on fixed income, said Marty Burbank, owner of OC Elder Law. Many retirees find their budget stretched by increasing health costs and market fluctuations, reducing investment income. Grocery bills are an area that they look to cut. Holiday sales. Okay, the holidays coming up big for retail. U.S. holiday sales are expected to grow at their slowest pace in 6 years, data from Deloitte showed on Thursday, as persistent inflation and dried up savings turned shoppers more frugal for all important shopping period. Rising credit card debt and possibility that many consumers have exhausted their pandemic era savings, which we just saw that chart, will likely weigh on sales growth and seasons compared to the previous one. Okay. Good news, mortgage rates have come down. Okay, the 30-year fixed rate mortgage declined by 14 basis points to 6.29%. Okay, it's reaching the lowest since February of 2023. So if you have a job and you have credit, you can still go out and get a mortgage. However, housing costs are still up, as we saw in the CPI. The Business Optimism Index, National Federation of Independent Business said on Tuesday, its small business optimism index dropped 2.5 points to 91.2 last month. Clearly, uncertainty has been on the rise, said the chief executive. And the stock market is expressing some unease as the elections is just weeks away. U.S. bankruptcy filings spiked in August after a slowdown in July, propelling the total for the first 8 months of the year to the highest level since 2020. Okay, 2020 was a pandemic. The second highest since 2010. What happened around the 2010 time? That was from S&P Global. The National Federation. So what I'm seeing, again, I'm not seeing that the economy, the macro economy, is doing very well. Okay, I don't see that the consumer is doing very well. I don't see that employment is doing very well. I don't see that inflation has gone away to the point that people are back, spending, and then they're feeling better about what's going on. This holiday season is going to be key to the retail sector. And if the retail sector doesn't work, nothing's going to work. And if housing sector goes down, that's going to be bad too. Again, not trying to be the Debbie Downer here, but I'm just trying to show you this is just a week's worth of data, that of reports that have come out. Okay, and remember a month ago when we had the crisis in Japan with the yen. Well, the yen rose to its highest level against the dollar since December on Wednesday, after the Bank of Japan policy member stated that the central bank would keep raising interest rates if the economy and inflation evolved according to its forecast. So will the carry trade come back? I don't know. Okay, that's what caused a part of the issue last July. Here's another thing that was kind of hidden. China-based banks are reportedly taking massive short positions against the US dollar, amounting to over 100 billion. The East Asian nation is quietly using this complex currency strategy to gain the upper hand, and the implications seem to be massive for the global economy. This strategy has led to billions in potential losses for the banks involved, while savvy investors pocket easy profit. This development comes at a time when Chinese stocks are teetering on the edge of a 5-year low, with the CSI 300 index down over 13% since May. Market players are now putting pressure on the People's Bank of China as traders expect the yuan to further weaken. According to the report by Bloomberg, foreign exchange swaps have become a key tool in China's currency management. The state-run banks are using these swaps to short the US dollar in an attempt to prop up the yuan during periods of heavy selling pressure. These positions have exceeded 100 billion since last year. It's expected that this strategy might help China to stabilize the yuan without burning through its foreign reserves. However, it has also put banks at risk. Reports estimate that banks have incurred potential mark-to-market losses ranging from 5 to 16 billion when the yuan drops earlier this year. If you look, our dollar has been strengthening, so that's not good for the yen or for these yuan, these shorting of our dollar. So again, we're an economy that's locked together. You can see what's happening in China. You can see what's happening in Japan. The German economy and manufacturing has slowed to a recession level. Our manufacturing has slowed in this country on top of everything else we just talked about. And so what's going to happen? Well, the Fed's going to cut rates, okay? The market's up today because they're happy that the Fed's talking about a 50 basis point rate cut, okay? 50 basis point, is that going to do anything? I don't believe so. It might temporarily have a stock market react in an upward position, but we've already seen when they start to cut rates, you see a recession hit, and that's just history. So again, how does this affect swing trading? Well, we can still swing trade because we're always going to find something. This week, our choices have been limited, okay? Towards the end of the week, they picked up a little bit, but it's not like it was, back in July when we had the trouble with the yen, trouble with the jobless reports, and it was like shooting fish in a barrel. But we'll have that time again because the markets are very sensitive right now And so again, I didn't do much trading this week because I didn't want to put my capital at risk. Did a pretty good job at the first part of the week. You guys have done pretty well from what I'm seeing in the Discord. So swing trading is a good way to hedge your bets against a longer term drop in the market, which I believe is probably going to come. That's my spiel. Is Trent back on?
Yeah,
There he is. I don't see his picture. Oh, there he is.
yeah.
Trent, you want to add anything to my rant?
Sure. Addressing the,
We can see you, but your mouth isn't moving.
can you hear me? Can you guys hear me?
We can hear you, but your mouth isn't moving on your picture.
Okay.
Yep.
Sorry, my computer completely melted down. That's why it disappeared. Pertaining to Japan and the yen is lower or higher than it was on August 5th. And one of the things they are battling is they're a very big exporting country. And as that yen rises, it digs into their exporting elements. So to control that, they're going to continue to raise interest rates, which it squashes the inflation element. And if they can drive their dollar down, then they become more attractive from a standpoint of exporting. And what I'm seeing is when I look at this, our US dollar is weakening. If I'm, our US dollar is weakening, which is not good for us. And I guess my whole point of it is all of it is you're seeing areas where currency that is once weak, Japan, that was the Kerry trade, is now strengthening. The dollar is declining, so our buying power is lessening from a purchasing standpoint. And you've got a situation where the Fed is now coming back in and doing. I'm re-listening to a book called Lords of Easy Money, and it's about the Federal Reserve and the actions that Ben Bernanke took, and what their actions of zero in Fed funds rates and quantitative easing has basically created this massive bubble. And in the attempts to, I guess, squash that or deflate that bubble, Powell has lowered rates or raised rates aggressively. But now we're in a point where he's like, okay, wait a second. I've got to start lowering them because liquidity in the marketplace is drying up. So where's the opportunity in all this? One, the bond market, if you look at yields are falling pretty. I think the 2-year was down like 1.5% so far today, which is aggressive. That's the yield going down, the value going up. So there's opportunity in bonds, but if the Federal Reserve,
what is the what is the 2-year yield at?
see if I can bring it up here.
What is it? What's the 2-year at right now?
Hold on. Sorry, my
And the only reason I bring that up is because if you look at what the Fed does, they follow the 2-year yield.
Yeah. Which I believe is at like
They follow the 2-year yield.
3.6. I think it's at 3.6%. So if they're going to follow the 3-year, they're going to drop 200 basis points. Which the last time they did that and they drove rates down, Fed funds rates, and then there's a lot of talk about quantitative easing, which is buying treasuries and mortgage-backed securities again and putting money back into the system. That could also be, it's at 3.57 right now. So, and it's down 1.84% today alone. So it's falling. What this could create as an opportunity, and maybe short term, but as this rate goes down, Fed funds rates go down, and if they get really aggressive and they do quantitative easing, that's going to put more liquidity back in the marketplace. And that liquidity is going to go to the highest risk asset class, which is technology. And that's what we saw during the 03 or during the early pandemic is that rate of the value of the Fed funds rate was so low, and were doing quantitative easing, putting gasoline in the engine, and the market took off. And so I'm looking at this going, okay, if you're looking for opportunities and you're patient, possibly in the next 9 to 12 months, you may get a great opportunity to buy high beta or high risk stocks. In the meantime, protect your assets, look at where money's going, and that is in low risk, low beta bond market, in particular the US Treasury market. So there's an opportunity everywhere. If you're an intermediate to long-term investor, there's an opportunity to make money in this market at this point, even with where we're at. So take that into account, because at some point this thing is going to break. And to be in the asset class that benefits from a break, US Treasuries in particular, bonds, there's a great deal of money, billions, that will be made because of this move. So that's my preaching today.
He's talking about this is the TLT.
Yeah.
This is a TLT on the monthly chart. And as of, we just got through August, 15 days ago, and you can see it's crossed over the 9 month. It has crossed over its initial support level, and now it's trading above the 20. And so from a long-term point of view, if you were an investor trader using the monthly chart, utilizing some of the techniques we learned in swing trading on the daily chart, this would show you, that would have been a time to get in. And this month we're still up. Of course, this month isn't over yet, but this is more of an investor's view. And you can see the MACD, the stochastic, RSI are all moving up. We went back and we looked at the TLT. Move this over.
Here's something to
and it
think
follows
about.
Inversely.
Go ahead.
Go ahead.
Here's something to
I was
think
just
about.
saying it follows inversely.
Go on.
Are you there?
Yeah, go
I
on.
think he's having trouble. Okay. So when the market goes up, like we've been seeing, okay, and let me put in compare. And let's do NASDAQ. This is kind of hard to see, but when the markets go up, the TLT goes down, okay? And then I want to go back to 08. I can find it. And it's really hard to see on this monthly. So the weekly, see if that does any better. So here we can see when the markets go up, this is the NASDAQ, the TLT usually goes down, okay? Down, up, down, okay? So I can get back to, I don't know if it'll let me go all the way back. Again, markets up, TLT down, markets coming back down, TLT coming back up. It's a slow way to do it, okay? But that's where people have made money before, like in the great financial crisis and back at the .com, is if you were in the long-term treasuries like a TLT, that's where you saw better gains. So I personally have in my investment side account, I have positions in TLT that are just investments at this point based on monthly charts and based on where I think, as a hedge against what the market's doing. So I still have a swing trading account that I'll swing trade in. I have an investment account, and I use the charts the same way, just more on a longer term basis. Trent, are you back yet?
Yeah. Can you
hear
you're
me?
back.
Okay, good.
Okay.
Yeah,
So
and you're moving. You're actually moving.
Okay, good. Maybe it's not raining again. The 2-year treasury is at 3.576%. In July 1st of 2020, it closed the month out at 0.109%. So if we are headed back down to where we were in July of 2020, the amount of money that is going to be made between 3.57 and let just out even at 1% is enormous. So if you're thinking using the swing trading strategy for 10, 20% of your portfolio, and then using the other 80% in a more of a long, intermediate to long-term conservative low beta allocation, this could be an idea to investigate. I believe you're going to see more, especially the movement we're seeing alone just in this month in the 2-year and 10-year is, I mean, it's enormous. I mean, the US 2-year yield this month, and we're only 13 days into it, is down 8.8%, which means the value is of those bonds are going up. And so if we do get this move, which I think we'll see in the next 12 months, this could be an epic intermediate to long-term trade. So something to consider. A little off track with swing trading, but I think coupling these two kind of thinking, there's a lot of money that can be made.
And we've talked about, I have a lot of money just in cash, and this week our treasury bills are just slightly over 5% for a 30-day bill. And we've been seeing that come down from 5.5, over the last 6 months, and still 5% for me is good to park cash in. And I still have swing trading on the side, so I'm very cautious on my swing trades. But I know, Paul, you've been doing lots of trading and doing pretty well from what I've been seeing, and that's how this thing works. We've got investment sides, and we've got swing trading sides, and we've got cash positions. Okay, so our money is always working. So if it's not actively in the market, which it doesn't have to be all the time, it can be earning 5%, or if you have a long-term investment account like I do, and like I said, I've had Berkshire Hathaway since Bees came out. Okay, I have that sitting over there, and I'm not too worried about that at this point. What would get me out of it? Probably if I saw, the long-term trend of Berkshire Hathaway going, for sure below the 200, day moving average on a monthly basis. That would be something that would be concerning to me. And the same way with if you're in an S&P 500 ETF, and that's your retirement fund, and you're watching it. I can pull this up and hold on a second here. And I'm going to go to monthly. There's your S&P. Okay, and so with this, the 200 is way down here. Let's go to a weekly. Down here. So basically, if you just did the 200 as your investment, the 200 is that red line. We didn't get under it here. It just bounced off of it. And this is the weekly chart. Okay, we are all the way back to 2020 here. Okay, it's not even going, but I would say you would have gotten out before the pandemic. It's not showing me anymore. But you have gotten back in. This line kept going down, probably right about here. In April of 2020, or May or June, or in April to June, or April to May, you probably got back in, and you would still be in the S&P on a weekly chart. Let's just pick this 304.32. So let's say $304. And on a week, you're just watching that 200, and here you got a little nervous. Nothing happened. And we're still going. And now you see on a weekly, we're up against here, but now we're at 562. So you went from 304 to 562 on a long-term investment look utilizing these charts. And the only thing I'm looking at is the 200-day simple moving average. Okay. So that's a pretty good return, and you don't have to look at it every single day. And so that's kind of what Trent's talking about, even with TLT,
Yeah. I think of one other thing. I was looking at yesterday's NVIDIA action. And yesterday, when it came to the options market, their options that expire today, the 120 calls, there was two different ones, 120 and 119. There were over 416,000 contracts traded on NVIDIA. And if you and to explain that, when let's say Bob calls me up and I'm at Goldman and he says, I want to buy 10,000 contracts of the 120 calls to expire today, Friday the 13th, say he did it yesterday. I have to go out and buy those contracts for him, which means then I'm short those contracts. So the way I hedge it is I go out and I buy 10,000 call contracts to hedge that, or I go out and buy 10,000 contracts worth of the S&P 500, which is like a doubling effect. You drive the S&P 500. And yesterday, NVIDIA represented 11.71% of the impact, had a 11.71% impact on the S&P 500 alone yesterday. The third biggest contract traded yesterday was the SPYs that expired today. When we got on today, when Mark started his talk, there were over 445,000 contracts already traded between two contracts that expire today on NVIDIA. The impact options are having on the indexes, on individual stocks, in particular NVIDIA, is gigantic. And the scary part of all of this is it can flip. It can turn around very rapidly. So as you're seeing, when you're looking at these swing trading opportunities, those stocks that are involved in, say, in the S&P 500 that you're swing trading, take into account where is the top 5 positions, the biggest asset or stocks in the S&P headed, because it can give you some insight to the direction of where the whole S&P is going. And right now, NVIDIA, Meta, Microsoft, Broadcom, and Google and Amazon are the biggest movers of the S&P. So they can be very telling of where it's going to take the rest of those, say, 495 stocks. So something to take a look at. It's blowing my mind how much options and 0 days to expiration options are affecting this market, and in a way manipulating it. And unfortunately, I think it gets to a point where it could go the opposite way. So be on your toes.
Okay. Anyone else have anything to say after us ranting and raving for a good part of an hour?
I'm on my toes.
He's always on his toes.
I'm on my toes.
Yeah.
I see a lot of this is the 5th day of
up.
Yeah, so I started trickling probably 2 days ago.
Yeah,
Just
I
a
can
little
see
bit.
that.
Yeah, just a little bit, and I'm ready to sell at a moment's notice. But I handpick. So I got into GEV and Oracle. Some of these the ones that I got a lot of momentum on them.
Mm-hmm.
So it's not too difficult. I think I'm nervous. I'm waiting for this thing to turn any minute, and I will sell it. So I'm watching it. But in the meantime, I'm taking advantage of this, what I think is going to be a small pop. So I'm already out of GEV. I got in 2 days ago. Oh, we talked about this, Mark. We talked about this. We talked about
Yep, we did.
What was the other one? There's 2 more. You put knee in there, which I didn't get into. And IBM's up. I think I still have IBM.
Yeah, the problem, I have this green line of death. You see the knee hit, and then IBM was, and I don't believe the green line of death was there when we talked about it. I said beware, and then IBM again right up against the sell level, but here it is, 3 days above the upper Bollinger, so it's seeing a little rollover here on the stochastic. But yeah, there were things out there that we talked about all week. That you just got to be more vigilant with your stops, because at any moment, there's just, Paul and I were talking about, normally I have a whole list of paper of stocks I watch, and like this week, it's just like nothing. It was just like so few to even look at, and you got to be patient. You got to let the market come and provide you with the setups. And there were a few, like, IBM was a nice swing. If we'd have got in back here, Paul, a nice
Yeah.
swing that would have been, so they're out there. They're just fewer and far further in between, but it'll come back. And so that's why I always say, don't be in a hurry to get in. I have things to do during the day, and if you can sit there and, like you guys do a lot of talking on the Platinum Live, and you do very well, analyzing, everything, and analyzing, volumes and directions and momentums and stops and where you want to get in. And it's fun to sit and listen to you guys talk about that, because you have different risk parameters out there. But I'm glad that you're covering the bottom side there, Paul, and using your stops and not losing any money on this, because you never know. You never know.
I wanted to go back. You had said that, the market's not looking too good in terms of unemployment, jobs. And, Yellen says, things are rosy. And, if things are so rosy, then why are we cutting rates? And like I said, I think if I had to re-say it, is they shouldn't be cutting rates if things are so good, right? If things are good, you wouldn't expect rate. And beware, if there's a 0.5 cut, things are worse than, the government knows that things are worse than they really are. So is that kind of what you meant?
Yep.
Okay.
Yeah. I mean, seriously, if everything's so good, then rate, look, the market's been going up, and up and up. We have our little downs, but with higher rates. Okay. So if it's the market, it's not the market. What it is unemployment's coming up, and they don't want to get unemployment out of control. And he even said that, up Jackson Hole, is like, we can't have it go up any further. And I've talked with David about it, and we see all the numbers, but then the unemployment rate and David hit it right on. He says they're not going to let it go up anymore. So it actually dropped down from 4.3 to 4.2, even though we have more claims going up, we have more, part-time jobs and full-time and all that. They're manipulating the data to maintain the unemployment rate. And I would say that if you went to the U6 unemployment rate, which is what most people consider the real unemployment rate, doesn't leave out these people here because they haven't looked for a job in 4 weeks or whatever. It's probably 8-9%. I haven't looked at it lately, but I would say it's probably 8-9%, on the U6.
It's really a scary thing when you're meaning the Fed is manipulating the data. And then what I put together with that is the narrative. I think we talked earlier this week about how that's how networks make their money, by watching stocks go up, not by watching stocks go down. So they have a special interest. So you essentially got non-credible sources, telling you things.
Yeah, I'm not sure the Fed is manipulating. They're using the data provided to them by Bureau of Labor Statistics, the Census Bureau, and all that to make decisions about rate hikes and unemployment and all that. And we, as a group of regular guys and gals, go in there and look at these reports every week, going, I'm not getting it. I'm not seeing what they're seeing, and I wish they'd explain it a little more, because part-time jobs aren't cutting it. Credit card delinquencies are up. Savings rates are down. Okay, jobs are, we're getting massive layoffs from big companies and small companies too. And the small companies are the heartbeat of the country. I
think Microsoft had a layoff today. I think it was today or yesterday. Yeah,
they did in their gaming division. I think. Yeah. And again, inflation, they keep saying inflation is under control. Well, it's not. Maybe the rate is under control. It's not at their 2% level yet. In fact, it's starting to turn the other way. Okay. So it's just keep that in mind, and swing trade away. That's what we do here,
Well, I did go back and watch Rick Santelli, and that was really something to watch.
Wow. I did see that. Again.
Yeah. Because you guys had brought it up. Yeah. I know David, Trent, and yourself had watched it.
Like
and it's definitely I would encourage anybody on this channel to go onto YouTube and look up Rick
Were you
Santelli.
able to find the full video?
I found it on
just-
someone's X account, but I didn't. When I went into CNBC, they didn't have it on. They cut around it.
Oh yeah, yeah,
Yeah.
Squawk
Hey,
Box.
yeah.
Yeah.
Here, I'm going to show you this chart real quick. Let's see.
I could actually show it. Maybe it might be worth showing the group.
Yeah, if you would, let's see this chart.
Let me
and
see if I
we-
could. Yeah,
Okay.
yeah, I'm gonna-
It is interesting.
yeah, I think it's great.
Can you see this?
Yep.
Okay, so this is the S&P 500. It's a monthly chart, and this is the Fed funds rate and the overnight bank rate. And so there's a lot of talk about, if he lowers rates, say 25 or 50 basis points, what should we expect? And if historically you look at this, if you go back to July of 2007, they were at 5.25. The next month, in September, they moved again. They were at 4.75. So that
50
move,
basis point.
what's that?
That was a 50 basis point drop.
Yeah.
Right.
That move, if you can look here, actually didn't affect the S&P. So they started, it wasn't until really they got into right in this area, December of 2007, and they went to 4.25, that the S&P started to sell down. And then once they got to September of 2008, that's when they got to 2%. And you see here the S&P started having big candlestick downward trends from September 8 into March of 2009, which at that point they were basically zero bound. And
That
that's
was
zero.
That's a great financial crisis.
That is. And so if you go back here, this is July of 19, they started cutting again. You're at basically 2.5%. Market went up. They were cutting into February of 20. Finally, February 20, the market started turning. So the message is this rate cut may actually be the opposite. There's a lot of talk the market's going to go down. This actually may spur on a run into the end of the year. It's then the additional rate cuts through the remainder of the year. And then if they have to get really aggressive, that's when you can see these market crashes that we have seen back in the great financial crisis, back in the pandemic. But it also, if they get this rate down into this, 2 to 1% or 2% and below, that's when these big bull markets take off. So just keep an eye on that, and just really, I think the next 3-4 months is going to be a time where they'll do their rate cuts, and it'll be all, everything's better, and the data is going to just get worse and worse and worse until something is said or something that breaks so badly, as we saw with Lehman, as we've seen, with the pandemic, they just shut everything down. That's when these quick bear markets are going to happen real fast, but they'll get aggressive because their behavior in the last 20 years is zero bound. And that just creates bigger and bigger bull markets. So it's just something to keep in mind as we see these zero bound Fed funds rates or quantitative easing programs kick back in. That's going to create more money in the system. That's going to create more risk on and more bull markets. So just keep that in mind as we inch down this market, and having cash in your pocket. I think it's going to create a lot of wealth, but it also could destroy a lot of wealth. You just got to pay attention, look at how these things are moving together or opposite of each other.
Yeah, I agree. I think, next week when they cut whatever, it's going to be a glee, bunch of glee. You're going to see the markets probably pop up until what you just saw happens, and, they start to realize what's going on, and they'll probably start heading down, and then they're going to, the Fed will continue to cut to try to get down to the 2% or the 2-year yield. The 2-year will probably continue to lead that down. Okay. When you put more money into the system, let's say they do cut rates, people and companies have to have the money to be able to borrow. And we're looking at banks that have tightened up their lending standards. So, what good is if I can get a 4% mortgage, but I don't have a job, or my credit is gone, or the bank isn't lending anymore, how many houses are going to get sold? And so it's a complex stew of economic stuff.
Think about this though. The whole narrative is they lower rates. That means the prime dealers are getting money at a cheaper rate to borrow at, but it doesn't necessarily. And most people, I would think, oh well, they're just gonna start lending that out. They're gonna start lending that out. Well, they lend out when rates are at zero, because they've got to get a return on that money they've borrowed, so they lend it out, and that's how they got aggressive with that. The latest housing boom, the latest market boom. If yields, if what the 1 month is at 4.94%, and I can roll that, and I can borrow money at a lesser rate and just go buy 1 month's treasuries and roll that money doesn't come back into the system and doesn't create liquidity. And with the consumer so weak and getting weaker, why would I, as a bank, want to take that risk? Why would I want to risk giving that to a consumer who may lose their job, who may not be able to make the payments on it? Instead, I'll just go buy treasuries, and treasury yields are at a weird place in history. I'd just go buy treasuries and mortgage-backed securities and reap the benefits from that, and let the dust settle if I can borrow from the Fed at a cheaper rate. So that may be something also to consider, is you may not see this money show up into the system until probably 12 to 18 months from now. And when they're really, Fed funds rates are really low and the consumer is really bled out.
I don't think it's going to get low. I think they'll cut rates. And I think what's going to happen is what history has told me. Inflation is going to start coming back up, and they're going to have to raise rates again to address inflation, because they're cutting rates to address unemployment. And historically speaking, rate cutting does not help the employment rate go up. Okay, so they're using the wrong tool to try to fix this problem. And you can go back and you can look at past rate cuts and what happened, in the past with Volcker and all these guys. And Volcker had to go up to 18%. Okay. So he had a different set of numbers that he had. The reports that we're talking about today were made up of a bunch of totally different data. So it's hard to compare. It's hard to compare unemployment back then to today, and all that, because they changed the reports so much.
Yeah.
Paul, did you find it?
It's actually on YouTube, but it's edited.
Oh.
It's so weird, but I have it recorded on my YouTube. I'm just trying to see if I could, I'm gonna try to take a look if I can find it.
I found it on someone's X account. They had recorded it.
It was like, oh my gosh, they're gonna let him talk? They're gonna
Isn't
let
it
him say
amazing
that?
Well, isn't it amazing CNBC has censored it, though?
Yeah.
3 years after the NCAA began allowing college athletes to earn money from their nation.
I think it was the 11th.
As a result, it's costing colleges
2 days ago.
It was Wednesday, yeah.
That's it.
The New York Times.
Have you seen the Eric Schmidt interview? He's the ex-CEO of Google. He was at Stanford and they interviewed him, and he was talking about AI and all this. And then he got into Google, and he says, I don't think Google, and basically paraphrase it, I don't think Google has it anymore. Because when he was with Google, people worked late. They worked 7 days a week. They were on a mission to grow Google. Today, people don't work past sunset, and people take days off. And Stanford posted this video on their university website, and a couple of days later they took it off. And I think it's because Google called them and said, you need to take that off because you're trashing our company. But it's true. you think about Google has had to adjust their
Paul's having an earthquake.
business. Oh, wow. Oh, there it is.
Oh, here
Okay.
he goes. All right. Here we go. Oh, need some sound.
You're on mute.
You're on mute, Paul.
Next week's obvious big FOMC meeting. Month over month headline.
Can you hear it?
2/10 exactly as expected. Up 3/10 when you strip out food and energy. That's a tenth hotter than we were expecting. And that equals April. To find a higher, you have to go to March when it was up 4/10. If you look at the year over year numbers in the rear view mirror, 2.9. That now becomes 2.5. 2.5 is the smallest amount going back to February of 2021. And if you look at year over year X food and energy, 3.2, exactly as expected, and exactly the same as the rear view mirror. And what we want to definitely pay very, very close attention to here are the indices. CPI index going all the way back to 1913 actually moved down just a smidge from 3.1454 to 3.1479. That's higher, but it's lower than expectations. And once again, that is the highest level since 1913. And if you look at the core indice, which only goes back to 1957, it also came in more than expected and more than our last look at 319.76. It has never been higher. We see that yields are moving up. And my guess,
I think they edited this.
Expectations, we can see that there was one outlier there, and that was the core month over month, the 10th hotter. If you look at the sequential aspects of this, of course, we see that the 2.5 year over year headline dropped 4/10. But once again, we could talk about all the significant progress we've made on inflation, but it's still not at 2%. Will it ever be at 2%? Does it matter? Well, it mattered when it was at 1.8, and the Fed wouldn't look at that as just steady pricing. It was below the target. We'll have to see how it all works out. We do see that the closes yesterday in twos were significant. That was a 2-year low yield close, and tens was a 15.5-month low yield close. And everybody's talking about the debate. I was a bit disappointed having kids and grandkids who can't afford houses and, of course, can't afford insurance once you buy them, or some of the other prices. It seemed like there was really an economic tone-deaf panel with respect to drilling down. If you give people $50,000 to buy their house, I think it sounds like a good idea. But I think CPI numbers might reflect that. Price of homes might go up about what? $50,000? Squawk box. Well, here we are, Joe. Back to you.
Yeah, he cut that. That's cut.
Okay.
Hold on.
By the way,
Oh, did it stop there? Did it stop there? Because that's where you kind of triggered him.
Let me see.
You think that if first-time home buyers are granted some money from the government, that it's going to increase prices for homes? Do you think
that's
what
what
happens?
prices have increased. Government policies. That's the problem. That's what the moderators, they never drill down. Young people, I feel so sorry for you. Really, I do. There's an economic dishonesty going on here.
Let me just ask then, since we're on the topic, Rick, how you feel about tariffs?
You know how I feel about tariffs? It's a bargaining chip. And many of the tariffs with China are still on. Once again, the moderators don't drill down on the two aspects of tariffs, but they do drill down on other areas that make no economic sense whatsoever.
But you don't think the tariffs raise prices? Just as a mathematical economic.
Listen, prices are going up no matter what, Andrew. Whether you do it on the tax side, whether you do it on the tariff side, our policies are silly. That we can't be Santa Claus. But all those programs aren't policies, they're promises that never get by Congress, and each one of them has a cost we can't afford because we've done this before. When you prepay and you make policies that don't make economic sense, you may think you're getting a benefit. Look at what we learned yesterday. Finally, wages reached 2019, but it doesn't reflect how much they've gone up since 2019. If you're out there and you're a young person, study up. Study up. All these superstars that made recommendations in such a timely fashion yesterday, maybe they don't feel the pain of what's going on, but I feel bad that they can't buy houses and insurance. You think the price of insurance are going to go down, Andrew? You think people in Florida that could barely hold on to their homes could afford 300% increases in their insurance?
There is no question about that. It's a very true statement.
Right. So why don't we talk about it? Why don't we talk about it?
Well, then there's other issues around climate issues and other things that are affecting basic Florida.
What issues did you learn last night?
It's a longer conversation, right?
President smart enough to memorize that Trump takes the bait, but the ABC people are like a turkey shoot.
Rick, we're going to continue the conversation right now about CPI. I want to get everybody's take on what we're just hearing as it relates to this inflation data. As if you wanted to
Finally.
Co-Chief Justice John Hancock.
Thanks, Paul. That was good.
And of course, our own Steve Leisman is here. Steve, I want to start with you and get.
This was a great report in line number 26 on the 3 millionth page, buried in 1 point type.
Yep.
Somebody got a job.
Thanks for doing that, Paul. That was good. Yeah, that was.
Yeah, that was good. He wrapped it all up nicely.
Is he? Did he have a heart? Miguel said it sounds like he's going to give himself a heart attack. I think he was close. I think he was close, about to blow a vein.
You know, he was pissed, and rightfully so. Right?
Absolutely.
He wanted to get the message out, and I remember him referring to his grandchildren more. I don't know. I just remembered a little bit different. And
he said something about grandchildren, I believe, in there.
Yeah. Well, he's talking about his grandchildren can't afford a house.
Right.
They can't afford property.
Yeah.
Yeah. It's probably the truest thing I've heard on TV when it comes to any of this in years. Yeah. And it's unfortunate.
Go to CNBC and you can't find it on their videos. So.
Yeah. It's crazy.
Yeah. It's again, here we are. We're just regular guys, all of us and gals together, and we're just talking about it. And, I tell you what I see, and I've been doing this for a while, and Trent's, was in financial planning for a long time. And I get to dust off my economics degree once in a while and go back and learn and see what's happening all over again. Like I was a kid in the 70s, or when I was graduating college in the 80s, and with inflation and, and then the great financial .com bubble. I lived through that in the industry. I lived through the great financial crisis. I lived through 9/11. I was in New York on 9/11, and we were buying a company. We're buying National Discount Broker then, and a lot of people in the financial services business lost their lives that day. And the market, it was Tuesday. The market didn't open up till the following Monday, but it opened up, and we have a pretty good market. It's pretty, I'm not going to use the word resilient, but it's a strong market, but it's also a market we got to watch. And it's not a market that's friendly to us retail traders and investors. So that's why we're here. Okay. For everyone to kind of put in your own 2 cents, ask questions. I don't know all the answers. Trent doesn't know all the answers, but certainly a lot of people on these calls that have a lot of experience and input. And I appreciate all you guys and everything that you contribute. And hopefully what we talk about on these Zoom calls is beneficial to you. So that's all I got. Anyone else have anything?
I'm worn out. I need a nap.
I know. Oh gosh. After watching Rick Santoli, I think I need a vodka.
Gosh.
Yeah. So Eric, you got anything? I see Eric's always here.
Yeah, I'm here just listening in, trying to learn.
Okay.
Nothing
So you
specific on my end, though.
You work in insurance, right?
No, not at all.
No,
Well,
that's
Jason. That was
that's
Jason.
Jason.
Okay.
Yeah.
Okay.
Yeah.
All right. Well, anything else? I guess no. We got
Jason was good in divorce.
Oh, that's right. Yeah.
Yeah.
I was going to talk to him about my insurance because he told me that they can't cancel you or raise your rates based on claims. And I'm looking around to find different house insurance, and I can't get any because they keep coming back that I had 2 claims in 5 years or whatever. Well, I can't help.
I'm
when
sure
the wind blows.
I'm sure he's going to have some ideas. He'll have some ideas for you.
Yeah, I can't help when the wind blows my roof off, but it is what it is.
Yeah.
So, all right. So we go ahead.
I just wanted to note that I think I told everybody that, you don't know when to buy NVIDIA or any of these big stocks or, how do you know, you see this very sideways action. I got my hand on the trigger to pull, to pull. I remember we talked about NVIDIA, Mark, a little earlier. He said, oh, geez, that's only one candle. And I'm like, yeah, it's true. It's only one candle. But then there was a second candle. And then you get a little more scared to go in. Did it go high or whatever? But the charts are guiding us pretty good through this upswing, through this week. And so far it's been good. And the oscillators and so forth. And it's not just the tech sectors. You see the insurance sectors. A few other sectors seem to be doing good as well. So there's money out there. You just got to be ready to pull out. That's all I
Definitely.
got.
Yep, definitely.
Mhm.
It's your money, and I don't want anyone to lose any money, and that's first rule of making money is don't lose money, so
Yeah, for
be
sure.
careful. Don't get caught up in your emotion and have a trading plan and follow your trading plan. And that's what I do. And it keeps me from going insane and getting mad at myself for making stupid trades,
I'm in Amphenol right now, and it's a hard one to hold on to because the 9 is trending down. But still, all the MACD is about to switch. It looks like it's on its way. But so when do you know when to get in? Geez, if I went by, I want to see that uptrending 9, but I might miss that little rise on the way up. So you just take a little or smaller position, to dabble in there, but I'm on the trigger too to pull out. I know it's a good company.
Here's what I don't like about Paul is it's right here on the green line of death, and I believe
Amphenol, not AMP.
AMP, okay.
Amphenol, APH.
APH, okay. Hit the wrong one.
Amphenol, yeah, it's all right.
Okay. Yeah, you got a lot of lines of resistance, right? You got the 50, you got the sell order resistance level. Yeah. But you got good support at the 20 so far. But again, like you said, just be careful. Know that the 9 is diving. Okay.
Yeah.
But you got some good oscillators. The MACD has not crossed yet. Okay. So hasn't been confirmed. So you're playing a little on the edge, but that's what you do because you're the machine. But you keep after it. I mean, you watch it like a hawk. So
yeah, watch it like a hawk, and I try to put on the Discord what I'm doing, and we have some. We've been having some reasonable, good conversations in the morning. David's there every morning, and Esther's been showing up. I know there's a guy from Scotland, James. I tried to get him on. I think he's on platinum now.
Yeah.
So we had a few regulars.
Good.
So it's good.
Yeah,
it's good.
I pop in once in a while and we have good conversations. So all right,
Cool.
that's all I got.
Cool.
Anyone
Mark?
else? Yeah.
Berkshire is almost triggering a buy signal.
Okay.
Berkshire looks amazing.
I'll probably
if I could share my screen, I'll show you what I use, not the Fidelity.
Okay. Here's what Fidelity tells me. It's telling me the MACD is dying. Telling me the Scholastic's dying. It's below the 9, below the 20. That's the I gotta get rid of that. That's the S&P. I don't need that in there anymore. No wonder I'm all mad. There we go. Yeah, I don't see it, but if you want to share your screen, on my trading
How do I do that on the Zoom call?
There, hold on.
Go down to share. Down
Go
at the
down to
menu.
share. There's a little green button at the bottom.
Share screen.
Yep, and then it'll come up with a menu, and you just click the one you want. It's on your screen.
Right there, I believe.
And then click it. There, it's coming up.
Did that work?
Yep, you're there.
Okay, working on this left side of the screen here. See this oscillator coming down here? Mirrors the nice move that Berkshire had down here. It's come right over the green buy zone. It just triggered a alert that the movement in Berkshire is getting ready to change. In any minute, we should get a nice green dot, which is what we got down over here. These green dots are perfect entry points. And you can look at every single one of these green dots, which is followed by the green dot, followed by the up. We're going to get a green dot here, and most likely we're going to get a nice move back up because we have faith in Berkshire Hathaway. So
Yeah.
you've got me convinced to watch this stock. I'm watching this new software I have. It is amazing how these indicators work. Every single stock works the same way using these. These green indicators are the flow of money. So the money flowed out as this thing came down. And now we're right here at the perfect buy zone. So be watching it because Berkshire is going to turn around here shortly.
How come you wouldn't see red? Oh, it's got to go farther.
Pardon?
Like you see how it goes, it turns from on the oscillator, it has I don't know if you, it's a graph. So it's green
see, this is
to red.
the red line up here is overbought. The one down here is oversold.
I'm talking about the cloud.
The cloud is selling is red, buying is green. And the very bright buying is overbuying. So you see how the bright green went away? See how the cloud's coming down?
It looks like when the green cloud converges to a red, that's when it gives you the triangle.
Yes. Well, usually you'll get the signal right as it's going to change. It's signaling a change. So you can get in right at the green dot. It doesn't go down much further than this. It won't stay there very long. If you noticed on all these charts, they never do. Whether it's up at the top or at the bottom, like here at the top, it stayed here from July 15th through the 18th. That's only a 3-day move. So what you'll find out is a lot of these stocks don't stay up at the top very long and they don't stay at the bottom very long. They're usually going back and forth.
Can you put NVIDIA in there?
Entry point here on Berkshire, hopefully coming back up.
Well, I think the nice thing that I like is you have a plan and a trading plan, and you're following your trading plan. My trading plan is a little different, and my charts don't come to the same conclusion as yours at this point yet. So
yeah, we'll find out next week.
Well, I'll tell you, and I'll tell you when I would get in right now. My indicators don't say what yours are, and this doesn't mean either one's right or either one's wrong. It just means we have a different trading plan, and I would rather have everybody have a trading plan that they stick to than to just willy-nilly buy and sell based on I think it's on sale or whatever. So
yeah,
well,
where I've made mistakes is as I've seen other stocks come down here with this red line down over the green, and I've gotten excited and bought it. But it was too early because we still didn't get the turn back up. You got to get the turn back up.
Yep.
And the green dot.
Yep.
So we should be getting that probably Monday or Tuesday.
Well, we'll check it out. We'll jump on the Platinum Live and we'll watch it together on your chart and my chart. We'll see how it works out.
Sounds good.
I think eventually they'll both be right though. So anyway, Trent and I got to go to another meeting, so we're gonna, unless someone else has something.
You are so busy.
Not as busy as you. Not as busy as you. You guys are really busy.
Hey, when you're retired, you got all the time in the world.
I know. Plus, you don't even have to make lunch. Your wife gives it to you every day. That's pretty cool.
All right, guys.
Thank you, and have a good weekend. And we'll be back on at 3:00 with Kerry, right, today?
Yeah. Yep.
Okay. All right.
All right, guys, take care. We'll see you later.
All right. Be safe out there. Be safe out there. All right. Talk to you guys later.